I'll be taking us on a session about technical analysis with candlestick wicks. Now we need to know that this is an introductory video into technical analysis with candlesticks and candlestick wicks. And one thing we need to know is that candlesticks and candlestick wicks are one of the basic concepts of technical analysis. It reveals the activities of buyers and sellers in the market. If you want to know how buyers and the sellers are reacting in the market, all you need to do is to open the charts and look at how the candlesticks and the wicks are moving, and you can quickly get an insight into what is happening in the market. So let's jump straight right in. So we can see here that we're talking about candlestick wick inside, and you can, if you look at this side, we can see that we have sellers on this side and we have buyers on this side, which means that our buyers are on this side of the market and our sellers are on this side of the market. So the sellers are trying to drive the price down, while the buyers are trying to push the price up, which is basically when the buyers push the price up. Let's say the price is $5 here, they want to push it up to $10, while the sellers want to push it from $10 back to $5. So this is basically what we get in a market situation, and the candlestick represents all this stuff that you see on the charts. Now we can see that the candle we have here is a big green candlestick that has a big green body. And if we look at the middle, we have an indecision candle. When you see a candle that has a long wick to the top and long wick to the bottom and has just a little body in the middle or little or no body in the middle, it is more of an indecision candle. And when we have a big candlestick like this that is red in color and more of a bearish candlestick, the red is showing you that the sellers are the major players in the market, while the green candlestick is showing you that the buyers are the major players in the market. So in this slide we are looking at bullish candlesticks, and if we look at it properly, we can see that this candlestick is a big green candle, which is showing us that buyers are stepping into the market. And if you look below this candlestick, there is a wick below it. And remember, in the first slide we said down here is the buyers and up here is the sellers. So the buyers came into the market and they pushed the price upward. Let's assume the base price is still $5 and the top price is $10. So they were able to successfully push the price up from $5 to $10. So this candlestick shows you clearly, when you see a big green candlestick like this, you know that the buyers are the major players in this market. Now, coming to this second candlestick, which may be a little controversial for those who are newbie, you will see that this candlestick had a big red bar on top of it. But the red bar on top of it, the red body, was not as big. The length of the red box was not as big as the wick. The wick was almost twice the size of the red box. And so it is a bullish candle in the sense that buyers, don't forget, buyers were here, sellers were here. The price was actually $5. But now the buyers step in and we are able to push this price up from $5, and probably it closed at $8, which means that the buyers are very much aggressively in this market, but the sellers still had their way. So though the red bar, they're showing you that this look bearish, but the bulls are coming in aggressively. And the same thing with this candlestick here. You will see that though it is a big green, there's a green bar on top of it, the size of the wick was twice the size of the body. So this finish, because there's a wick on top of it, this closed at a $9 price, which shows that the buyers, the bulls, are aggressively in this market. And the same thing with this candlestick. And then when we look at this candlestick, we may want to argue that this is an indecision candle. But if you look at it properly, the size between this space here and this space here are not equal, which is showing you that the buyers were able to push the price from 5 and it closed at a $7. Though it was supposed to move to a $10, they would have wanted it to move to the $10 price. But the sellers also step in and were able to push the price from $10 back to $7. But the buyers had their way. So this is more of a bullish candlestick. So in this slide, we have a look at candlestick wicks. And we are looking at the bearish candlesticks. I know a lot of traders don't like the color red, but as time goes on, you begin to find out that either red or green, you don't care. You just like anyone once you know what to do. So we are seeing that we are having a full red candlestick here, which is telling you that in this time period, the bears were fully in the market. Now, if you look at the second candlestick, you'll be able to see that there was a long wick on the top. Remember, I told you this is sellers and these are buyers. So the long wick at the top is telling you that the sellers were able to push the price down from $10 and it finished at probably 5.5. So the sellers were fully in this market. Though they weren't able to push the price down to $5, they were able to push it to 5.5. Which is showing you that this is a bearish market. The same thing with this candlestick. You can see where the bar is located. And even this one, some people will argue that this is an indecision candle, but the wick to the top is longer than the wick to the bottom, which qualifies this for a bearish candle. And if you look at this candlestick again, you can see that it has a sign that buyers are in the market. In this candlestick, there is a sign that buyers are in the market, which is this place, telling you that the buyers were able to push the price up from $5 to probably $6. But it is not a bullish market because the bears were fully in control. This is not an aggressive move. It just shows the presence of buyers in the market. But the buyers were not able to fully take control of this market. So this is a full bearish market. Let's check the next slide for the next line of action. So in this slide, we can see that in the candlestick wick insights, I was going to explain how a wick is being formed. Now this is a bearish candlestick. We can see the body is showing us that this is a bearish candlestick. It took over more than 50% of the wick. And now, when you see a wick being formed on a candlestick, this is the concept of a wick forming. These are buyers. These are sellers. Now, the buyers and the sellers were equal, and so they formed a candlestick at the top. At the bottom, the buyers and the sellers' impacts were equal, so they form a candlestick at the bottom. Now, for the rest of the day, the sellers were in control. So we have a big red candlestick with a wick to the top and a wick to the bottom. The same thing happened here. So I think it's more straightforward. You can pause the video, look at this stuff, and understand how wicks are formed. Every time we see a wick on the top of a candlestick, it is a sign of rejection or reversal. So the longer the wick, the stronger the rejection. And when there is no wick on either end of a candlestick, it will mean that an aggressive supply or demand was in that market at that time frame, as the case may be. What we are trying to say here is that whenever you are seeing a long wick here, it is simply telling you that, look, the participants were rejecting the price at this point, which is a $10 price. So there is a price rejection, that every time the price hits $10, there's always a rejection. So it is part of trader psychology that we may need to understand as we continue in our trading class. And when you see a long wick here, it's showing you that there's a rejection and there's a reversal. So when we look at this chart, we can see for ourselves. When you look at this point, you can see this rejection happening here. That when price got to this level, it was rejected. It got to that same level here. It was rejected. So every time it is being rejected, you can see how the market went down. And then when it got to this point, look at the wick here. It was rejected and it went up to this point. There were signs of rejection. You can see the wick. This was a zone and it was rejected. And when it got here, there was a rejection and it went up. And look at this. So the wicks are always coming into play to tell you that, look, right here you can see that this wick was longer than the body of the candlestick, which was showing you that there was more rejection at this point. And we came in here, there was rejection, and you can see the market went down. So every time you are seeing this kind of move, you must be able to anticipate what line of action is going to take place next. If you look at the bottom of the chart, you can see that this candlestick here had a very long wick, the longest wick, showing you that they were rejecting the price here. This was a price where buyers decided that this price is attractive and they began to buy, and the market went up again, and it came to this point again, and there was another wick here, and the market went down, and there was another wick here. And you can see the longer the wick, the stronger the rejection. So basically that is what I want to explain with this video. I hope it is helpful, and if it is helpful, you can just do me a favor by liking, subscribing, and clicking on the bell notification button by the side so that you will be the first to get videos when I post them.